You didn't just watch silver rise this week. You watched it explode. It ripped through the $90 level, then whipped so violently intraday that even experienced traders felt it in their gut. And the crazy part is, that sharp drop was not the end. Buyers came right back. So now everyone is asking the same question. Is silver about to go even higher? Or was that the top? Because here's the part that's catching attention behind the scenes. The next level traders are talking about is not 95, not 100. It's closer to 106. And when a market starts floating numbers like that, the next thing that usually appears is emotion. Then excitement. Then FOMO. Before we go deeper, let me be direct. I focus on original analysis. If you value that, support the work by staying connected. That's how real communities grow. Now let's unpack what's actually happening. Silver has been building pressure for a long time. Then 2025 flipped the switch. Momentum accelerated. Volume expanded. And suddenly silver stopped being an ignored asset and started becoming something people chase. You can see it in behavior. People who never cared about metals are now asking where to buy. People who laughed at silver a year ago are now saying, did I miss it? That shift matters. Because markets don't move on charts alone. They move on psychology. And psychology is where wealth is made and destroyed. When price accelerates like this, certain technical tools tend to show up more often than most people want to admit. One of them is the concept of measured moves. Not because it's magic, but because it reflects how crowd behavior often repeats. Silver surged, peaked, pulled back, then formed a clear structure. When traders map that structure, two zones stand out. The first acts like turbulence. Price hits it, volatility spikes, weak hands panic. Then the market reveals where the real demand exists. That's exactly what we just saw. A sharp drop. Fear. Then buyers stepping back in aggressively. That is not weakness. That is strength disguised as chaos. Markets that collapse don't recover that quickly. Markets preparing for continuation often do. The second zone is where things get psychologically dangerous. That's where the number around 106 comes into play. Not as a prediction, but as a reference point many participants are watching. And silver is not a calm market. We've already seen daily swings of 10 to 15%. That is extreme. That is a market capable of massive upside and brutal downside. There is a reason volatility is increasing. As prices rise, exchanges often increase margin requirements. That forces leveraged traders to post more capital or liquidate. Liquidations create sudden crashes. Those crashes create fear. That fear convinces people the rally is over. Until it isn't. Now here's where psychology becomes critical. A lot of holders are already taking profits. Not because they're bearish, but because they're sitting on gains they never expected. Their portfolios became unbalanced, so they trim. That's rational, but here's the trap. People who sell early often end up buying back higher. Imagine selling at 90 because you felt smart. Then price hits 97, then 102, then 106. At that point, logic disappears and emotion takes over. That's how FOMO forms. and FOMO near key levels often leads to either sharp corrections or long, frustrating consolidations that exhaust everyone. That's why the real question is not just, can silver hit 106? The real question is, what happens after it gets there? There are two main possibilities. The first is continuation. Silver reaches the level, cools off, consolidates, builds a new base, and later pushes higher. In that scenario, the move is not over. It's just pausing. The second is exhaustion. Silver reaches the level, forms a top, breaks structure, and begins a deeper correction. Not because the long-term story is dead, but because parabolic moves often unwind brutally. History supports that. In 1980, silver collapsed over 70% after the peak. In 2011, it collapsed over 60%. That is not fear talk, that is history. So, if silver were to reach 106 and then experience a normal large correction, price could easily revisit the 40s or 50s. Not as a prediction, just as mathematical reality based on historical behavior. That's why planning matters. Not panic, not hype. Planning. You don't need to sell everything. You don't need to trade aggressively. But trimming into strength, rebalancing, and understanding risk is how people survive cycles. You can always buy an asset again. You can never buy back wasted time. While most attention is locked on silver, gold is doing something quietly important. Gold doesn't move with silver's violence. It moves slower, steadier. That's why serious capital respects it. Gold tends to be a signal of nervous money. When gold trends higher, it often reflects deeper concern under the surface. Measured projections in gold suggest zones in the low 5,000s are being watched by many participants. Not as certainty, but as structure. And gold also corrects. Even gold can drop 25 to 35% during major unwinds. When leverage breaks, it hits everything. That brings us to the third metal most people overlook: platinum. Platinum has already doubled over the past cycle. Structure projections place zones in the mid-3600s as areas of interest. And historically, when metals move together, capital often rotates between them. Gold first, silver next, platinum follows. It doesn't mean every metal moves equally. It means capital flows where momentum builds. Now let me ask you something serious. If silver drops 20% in 1 week after a major level, how would you react? Panic? Hold? Buy more? Your answer matters because it defines your psychology. And psychology matters more than analysis. Here's another question. If you could only hold one metal for the next year, gold or silver, which would you choose and why? Because choices reveal mindset. Metals don't exist in isolation. They live inside a broader market. Stocks are still pushing higher, but they feel stretched. Confidence remains high, but confidence often peaks before markets do. Short term, equities may still grind higher. Liquidity can keep markets elevated longer than logic allows. But when sentiment eventually flips, correlations rise. Stocks fall. Metals fall. Crypto falls. Even safe assets drop temporarily. In those moments, cash becomes power. Not because cash is exciting, but because liquidity gives you options when others are forced to sell. This leads to a simple framework. Stay with the trend. Trim when things become overheated. Step aside if structure breaks. Never marry an asset. Always respect risk. No one knows the future. Not analysts, not banks, not media. The only thing we can observe is price behavior. Price is the scoreboard. Strong participants focus on structure, on trend, on risk, on consistency, not on predictions. Parabolic moves feel amazing while they're happening. Everyone feels smart, everyone feels confident. And that's usually when risk is highest. Silver is the wild stallion. Gold is the steady horse. Right now, both are running. The practical approach is not trying to call tops. The practical approach is watching behavior as price approaches major zones. Does price climb steadily? Does volatility spike? Does volume surge emotionally? Does structure hold after pullbacks? The behavior after the level tells you more than the level itself. If silver reaches a zone like 106 and holds higher lows, that's constructive. If it reaches the zone and breaks structure aggressively, that's warning. Markets never announce tops. They whisper them through structure. Long-term holders have a simple challenge. Don't sabotage yourself emotionally. Silver regularly drops 20%, sometimes 40%, sometimes more. People who survive cycles are not the smartest analysts. They are the most prepared psychologically. They expect volatility. They plan for discomfort. They avoid emotional decisions. The crowd always believes they will sell at the top. Almost nobody does. The better strategy is selling in portions. Let the market pay you gradually. Keep a core position if you believe long term. That way, you don't need perfect timing. Gold rising alongside silver tells us fear is still present in the system. Liquidity-driven environments can lift everything together, until they don't. When unwinds happen, everything correlates. That's why discipline matters. If silver reaches a major zone and then goes quiet for months, attention will disappear, views will drop, hype will fade. That boring phase is often where the next opportunity forms. Crowds hate boredom. They only show up for excitement. Big moves are usually built during boredom, not during hype. Targets are not destiny. They are checkpoints. Narratives drive markets further than fundamentals in the short term. But narratives also reverse faster than fundamentals. That's why discipline always beats excitement. Selling does not automatically mean weakness. Sometimes profit-taking allows markets to reset and build higher. Again, structure tells the truth. Rebalancing is not bearish. It is professional. The biggest trap in every bull run is believing you will sell at the perfect top. Very few do. The consistent approach is trimming into strength and protecting time, not chasing perfection. Time is the most expensive asset you own. Silver, gold, platinum. These are not just charts. They are psychological theaters. They reflect confidence, fear, liquidity, speculation, and trust in systems. Right now, all three are signaling that something beneath the surface is shifting. Not tomorrow, not guaranteed, but behavior rarely lies. So stay sharp, stay grounded, stay patient. Watch structure, watch behavior, not headlines. Because when the next phase arrives, it will reward preparation, not prediction.